Good evening, everyone. Good evening. Thanks a lot for joining us today on a Sunday. Uh, I hope all of you are excited to hear about our take on the market crash and what we are doing to safeguard your wealth during this volatile period. Um, to people who don't know about Wright Research is a investment advisor which works using quantitative methods. We have a number of exciting strategies like the momentum strategy, innovation strategy, and multi-factor strategies that give you a very good exposure to different things in the Indian market. We have been functioning for more than 3 years, and we have a lot of people who are interested in what we do. Uh, Obviously, we have performed really well when the markets were strong, but now that the market is a little volatile, we have been seeing people, getting concerned that what will happen as the volatility comes into the market. What will happen if, let's say, a bear market starts, right? To address all these concerns, we are organizing today's session. And what I'll do is I will present a short presentation for you guys, and then we will do a live Q&A. So we have actually shared a few polls with you guys. We have, uh, shared a forum link with you guys. So we will be taking up all the questions that you have posted before, and we will be addressing your live questions as well. So let's get started. So the topic that we say is, why do we say inflation first? Because, inflation is the biggest concern that everybody is worried about, right? People are concerned about inflation. That's why, your central bankers are raising rates, and, that is concerning everybody. So we want to discuss all this. We want to discuss what is the outlook. But before we start, we'll do a very, very quick poll that will come on your YouTube chat link. The poll is that when the markets crashed, what was the index in India which crashed the most? Which one do you think was the index that crashed the most? So we will take like a couple of minutes here where we will collect all your answers, and then we will see what, like, how many people are correct here. We've got 7 votes till now. Let's, wait a few more seconds. Okay, so the our polls are in. 87% of you said it's small cap index, and 12% of you said it is the Nifty 50 index, right? So if you look at, what crashed the most, actually the small cap index crashed the most. The small cap crashed almost 15%, whereas, your mid cap and Nifty, crashed somewhere around 8 to 9%, right? I mean, the maximum they crashed was around 10%, right? So obviously it is a concerning crash. Obviously the market has not been very, very favorable since October also, right? Since October of last year, the markets have been choppy. But now, when the federal rate hikes were announced, we saw a very, very sharp correction, especially in the small cap space. We had also posted a poll on our social media handles, Twitter, Telegram, Instagram, and LinkedIn, where we asked you how much did the US market crash since April 2022. And a majority of you have actually given us the correct answer, which is 20%. The markets, the global markets, have crashed much worse than the Indian index. The S&P 500 is at its 52-week low, and it has crashed almost 20% since April. At the same time, Bitcoin, which is the cryptocurrency, the main cryptocurrency out there, has crashed almost 40% in the last 2 months, right? So which is a big jerk on that particular currency. So obviously there has been a lot of volatility. People have been worried across the market, be it India market, be it global market, be it the currency exchanges, right? So there has been a lot of volatility which has caused concern. Now we'll do another poll right here, which is about the sectors, right? So which sectors do you think, you know, are doing well? Can we have the next poll? Yeah. So which sector fell the most during the crash? If you guys could answer this here, we got some few votes for banking, few votes for IT. Let's collect a few more answers here. I can see people voting for IT and auto as well. So take your time, fill in your answers. Let's see how many of us can get this correct. So we have got a decent number of answers here. So if you look at the answers, you guys are correct. The IT index actually crashed the most during this time, right? Which was surprising, right? So whenever we go into a bear market, whenever there is a cycle where the Federal Reserve is hiking the rate, typically you expect US markets to do better, right? Because their currency is appreciating. And IT should appreciate because dollar they get their revenue in dollars, so IT should do well. But in this case, we saw that IT did the worst. And why did that happen? That happened because all these IT giants are collecting their revenues from US IT companies, right? And the US IT companies are in a huge turmoil right now. All your big, FANG stocks, big tech stocks, everybody is crashing majorly during this turmoil. So that's why our IT industry also did not do that well because it has exposure to those stocks. But apart from IT, you would expect media, realty, PSU banks to do bad, and those things did bad. And typical of a bear market, your FMCG, auto, energy, and these particular sectors did strongly, right? When you talk about factors, right, what are these major themes that are out there in the market? So which theme did the worst? So obviously, all your high risk themes like momentum, like your alpha, did really, really, they crashed the most. And why did that happen? That happened because, when you, because these themes, they do invest into overvalued stocks, they do invest into stocks that are trending at a rapid pace. So when you invest into overvalued stocks, whenever there is a crash or a volatile period in the market, people sell those stocks first, right? So that is what we saw, that your momentum and alpha sort of crashed first. But on the other side, your volatility, which is, which invests in low volatility stocks, did really well. And growth, which is where we are investing into high growth companies, companies that are posting good earning growth or revenue growth, those things did really well because at this time, cash is most important. Whoever is making revenue is the most important in this particular market. So that's why these two things did well. Now, again, we have our third poll here. Um, so we'll talk about the Wright research portfolios now. I'm sure a few of you have actually invested in these. So which one of the Wright research portfolios was the most resilient, right? So which one did not crash that much? And the question, the answer to this is going to surprise you. So we've got a few answers right now. People are talking, people are saying that it is the balanced portfolio or the growth portfolio. But the answer here is going to actually surprise you guys. Um, so the actual answer here is that our small cap portfolio actually did the best. So while the in the market all the small cap indices crashed the most, the right small cap index did the best, right? And we have actually beaten the index by a wide margin in the last month and 3 months, right? So surprisingly, the small cap index did the best, and then it was followed by a conservative, quality, balance, growth, and obviously, momentum, which is high risk, innovation, which is high risk. They suffered the highest among the right research portfolio. Now, in the last, looking at our overall update, obviously the last 3 months or last 1 month has been volatile, but recently in the last week we've seen very strong pickup in our innovation, in our momentum, in our quality basket, and we are going to really consolidate the risk management in this basket, which is what we are going to talk about in this particular session. So now, why did the market crash? We saw how spectacularly all the markets have crashed, right? How spectacularly, your Indian markets, how spectacularly global markets, sectors, factors, our portfolios, everything has crashed very spectacularly. But why did this crash happen? So we actually posted a poll to you guys on a social media channel, and we asked what was the reason for this market fall. So some people, we asked, is it inflation, is it the rate hike, or is it FI selling? And a majority of you gave the correct answer that a combination of all these three things has actually caused the market to crash. Now we'll do another live poll out here, and the live poll will be out there on your chat window. So why are the central banks hiking the rates, right? So why do you think the central banks are right now raising the rates? Why did the RBI rise rates? Why did the you know Federal Reserve is hiking the rates? Other central banks in Europe are hiking the rates. Why is this happening? Is it to control the money supply? Is it to shrink the balance sheet? Is it to curb inflation, or for all of the above? We got a few votes here. Some people are saying it is to curb the inflation. Some people are saying that all of these three things are actually causing this rate hike. That the central bank is concerned about all of these things. So if you look at the answers, all of the above has won, and all of the above is actually can be the correct answer. But I think the main reason why the central banks are really worried is because inflation is rising to a crazy pace in the US, right? So if you look at these numbers, look at the chart for inflation in the US, right? So this is 25 years history, and the US market has never seen such high inflation, right? So whereas in India we do see inflation sometimes 6%, sometimes 7%, it's very normal. But in the US, for the first time, the inflation has reached 8%, and those guys are really, really worried, right? The Federal Reserve, which controls the money supply, is really worried. So why did this inflation rise? So one of the reasons is, obviously the US central bank printed money at a very, very rapid pace, right? So when the central bank prints money, that the money in the system should equal to the output of the industry, right? But if there is too much money, then your prices are going to go high, right? Because it's too much money, but the demand remains the same percent. So one of the primary reasons for this is the central banks printing money, but that is not the core reason, and we'll talk more about it. Second thing is that, and then in this chart you can see that the rate hikes have been at a very, very rapid pace, right? So very quickly the US central bank has hiked rates because their macroeconomic conditions are getting worse. They are seeing inflation rising to very rapid numbers. They are seeing their bond yields rising. They are seeing their yield spreads, which is short-term bond yields minus long-term bond yields, that is turning negative, which means that there is a lot of concern about a recessionary environment. So the central bank is trying to control all that by hiking these rates. We have our fifth poll out here, which will come out on your screen. So recently RBI has hiked rates, right? So how much has the RBI hiked rates? Let's find out. What do you guys think? Some people are saying 40%, some people are saying 40 basis points, some people are saying 50 basis points, somebody said 25 basis points. Yes. So the correct answer is 40 basis points. Suddenly, the RBI on an unscheduled meeting hiked the rate by 40 basis points, and what they said is that the inflation is getting a little bit out of control even in India, right? Even in India, the inflation is nearing 8% mark, which is, obviously we've seen that in India, but it is outside of the level that the RBI is comfortable with. So as we reach high inflation, so RBI suddenly hiked the rates. They were also looking at the Federal Reserve, right? If the Federal Reserve hikes rates, then we will our credit market will become unattractive. So the RBI also matched that by hiking the rates. And even in India, we are in a concerning position macroeconomically that inflation is rising. Our currency is at the lowest level of all time, and we have to uh, control that. The RBI is trying to control that. Now, another major concern that we have is the Ukraine and the crude prices. So when the war in Ukraine happened, uh, Ukraine and Russia, they are all major commodity exporters, right? So because of that war, certain commodities like the crude oil, the coal prices, a number of metals, a number of agricultural commodities, they hit their highs, and they haven't, come down significantly. So there is still volatility, there is still concern around that. And so whenever the commodity prices go up, all the industries which are consuming commodities, all the industries, which are consumers of commodities, they will face supply side pressure. So they will, hike their prices, right? If a FMCG company that uses, let's say, palm oil from Ukraine suddenly sees that, that commodity has become pricey, what they will do is they'll hike the rate of their soaps or, whatever, chips or whatever they're creating, because, their input costs have gone high. That is leading to inflation. So why exactly is the inflation rising right now? It's not a simple answer, right? So while simple math of inflation will say that whenever there is too much money in the system, right, it should cause inflation. But inflation has a number of interpretation, and inflation is not just interpreted in a different way by normal people like us, but even central bankers have different interpretations of inflation. So, whereas obviously, the US printing money caused inflationary environment because there was a lot of money in the system. But, that money was actually consumed by the people who were, struck by the pandemic, right? And it was a short period when the money was printed. It was not like, over a 10-year period or 5-year period, there was a lot of money printed. Short period of time where the money was printed, obviously they could have printed a little bit less, but yeah, it is a transitory effect that happened. Secondly, obviously, the Ukraine crisis, again, a transitory thing, right? A war is a short term thing, right? It might last for 6 months, 1 year, but it's not like a long term thing. So these things caused inflation. And obviously, during the pandemic, when all the industries got shut down, right, suddenly, uh, so obviously there was supply shock. People were not getting the essential commodities that they needed, so that sort of spiked up inflation. So it's a mix of different things that are causing prices to rise. But again, there is a lot of nuances in the inflation math. So it's not very simple to say, this is inflation is getting worse and it is going to destroy the economy. What might actually happen is that the pandemic linked inflation and the commodity prices linked inflation might end up being very, very short term and transitory, and we come back to a normal course of business quickly. So, so it's a very difficult thing to pan out, and we will look at what the history tells us to form our conclusions about these things, right? So, what does the history tell us? The first thing, the most important thing that history tells us is that after every crash, that every significant crash that has happened in the market comes back stronger, right? The markets are a machine that compounds, and obviously short-term supply demand shocks, short-term corrections are part of the process. But in the long term, the market always recovers from any particular crash in a very, very strong way. So if you look at 2001 crash, if you look at 2008 crash, if you look at 2011 crash, 15 or 2020, every time the market has had a major crash, it has come back very strong in 1 month, 3 month, and 6 month horizons. So the market always comes back stronger from the crash, but it always happens uh, in the long term, right? So the crash, it takes some time to pan out. You will reach the bottom at a certain point, and it is very tough to say when you have reached a bottom. But once we have reached a concrete bottom, the market comes back very strong after that. Second thing is that, obviously the crashes that I showed you, these are all not because of inflationary concerns or rate hikes, right? Only 2011 might be one of those crashes, but other times there have been other reasons that have caused the market to crash. So now let's look at what happens when such rate hike cycles come up in India, right? So when you look at it, you will see that 6 out of 9 instances of rate hikes, the market always ends stronger, right? The market stays robust even when the rates are being hiked. So, we don't, so everything is not ruined because, the rate hikes are happening. The market can actually come back stronger even during these rate hikes. Now, talking about the outlook, right? What is going to happen? We hear about, if you are following the US market, the term recession and negative yield spread and all is thrown around a lot, right? People say, okay, uh, the economy, the interest rates are hiking, the growth is slowing, and when you hike the rates when the growth are slowing, you will push the country into recession, right? So that is one narrative that is coming out. But the second narrative that is coming out is that this inflation that we are seeing right now might actually be transitory, right? What that means is that during the pandemic, certain things happened, people accumulated a lot of things, right? And now they are not spending as much as they did during that time, right? So and all the large US companies have built up their inventory, so they might end up actually lowering the price instead of hiking the prices, and this inflation might end up to be transitory. So that is the second viewpoint. People think that by the end of the year or in a few quarters, the inflation would go down, but because the central bank is hiking the rate, you will also see growth decelerating, right? Whenever the central bank hikes rate, it becomes difficult for us to borrow money, right? So if companies are not able to borrow money, they will find it a little difficult to grow, right? So, so that is the second worry that is there. So one scenario that could happen is that uh, inflation is not able to be controlled, and there could be, and the growth also goes down. So gives that is giving a fear of recession to people. But the second scenario which might happen is that the inflation automatically goes down, and the rate hike might end up decelerating the growth. So in that scenario, what we might see is that the countries will start boosting the infrastructure again, right? So people might start, like India, they have their PLI schemes, they have all these, they have strategic investment in all these sectors, right? Like semiconductors, specialty chemicals, white goods, etc. So India might start doing investing in those. Similarly, the US might start doing strategic infrastructure spending. And we've also seen this example from China, right? China was one of the first countries that hiked rates last year itself, right? And now, and when they hiked the rate, all these crises started happening. The Evergrande crisis, where real estate giants were being crushed, and now they are at a stage where they have to cut rates, right? They have cut rates and they're trying to boost the economy. So there's a lot of lessons to be learned from China itself, and we'll have to see how the things evolve going on into the future, right? But obviously, the inflation has shown a sign of easing in the US, and which has gone down a little bit, but it is not as low as expected, which has caused another concern. But we might see inflation actually going down at a rapid pace in the future. Now we had asked you a question that which are the best performing sectors since April 2022, since the crash happened. So a lot of you have said FMCG across all platforms, and some people have also said auto. So actually, FMCG and auto were the best performing sectors, like we saw in our previous slides. And if you look at, this is a pattern of what happens in a bull market versus what happens in a bear market, right? So in a bull market, you see, your real estate, IT, banks uh, do very, very strong, and actually everything is positive. But your cyclical sectors like real estate are doing really well. But when you come to bear market, you see that only the safer sectors like pharma, FMCG, energy, and even IT, right? IT right now is volatile, but in a typical bear market, IT is strong, right? And commodities also, tends to be strong because, there is inflation out there. The historical analysis tells us that pharma, FMCG, metal, and energy will continue to do well in a bear market, right? And which is what we have seen right now, which is why a lot of people are calling this a bear market. Now we have a very interesting chart here about sector rotation, right? So the economy and the market, they all go through cycles, right? We all know that the market is not one thing, right? It keeps changing scenarios from one time to another. It doesn't go like, there is a 6 month uh, recovery and 6 months, recession. It's not like this. The time periods are different, right? So there might be a very short bear market, but like a long-term recovery period. So that the time is not defined, but actually the market goes through these cycles, right? So whenever you go into like a bear market, right, you will see that the healthcare, your FMCG, your staples, and your energy sectors, they start doing well. As the bear market finishes, reaches the end, you see healthcare, finance, and utilities start doing well, and then all your cyclicals will start picking up, right? So right now, which sector do you want to invest into? Banking is the best sector to invest into. Banking is a good sector to invest into because rates are rising. Your commodities, your big companies, right, which have a lot of cash, which are sitting on a lot of cash, they will not face any problems. Your tech firms, your FMCG, oil and gas, banking, transport are good sectors to look at right now. Now, to be reached towards the end of the presentation, where we'll talk about how do we at Wright Research do risk management, right? So our risk management has a number of layers. We do dynamic allocation, we do deallocation extreme cases, we allocate more to gold and bond to save from equity volatility, and we are adaptive during macro cycles, right? So at the core of all our models, there is a regime model, right? We try to forecast what type of a regime we are in. Are we in a volatile regime, or are we in a bullish regime, right? So whenever there is a bullish regime, we try to do more high risk investing, right? We try to invest into strategies like momentum. We try to invest into high growth strategies. But when the market becomes volatile, we suppress our risk appetite and we say, "Okay, let's invest less there and let's do more in safer strategies, right? So that is the dynamic adaptiveness of our model. In our multi-factor strategies, we have asset allocation, right? So if you invest over there, you see that we have been investing a lot into gold. Like we have more than 20% allocation to gold there for a long time, um, and you will see here that during the volatile periods in the market, like 2020, we had up to 50% deallocation to bond, golds, and other ETFs, and we go out of equities in volatile times to manage your asset allocation and give you a low risk appreciation of your capital. So that's how we manage the risk in our multi-factor strategies. in our momentum and other strategies, we try to be much more, we try to give equity allocation all the time, but only in very, very extreme cases, we take out the money and put it into cash, right? So this is called the deallocation policy. So if you invest into our momentum portfolio, you will see that, periodically, whenever there is more than 10% drawdown in this particular portfolio, we take out the cash, the money from equities, and we put it into liquid Bs or cash, right? And so if you look at this chart here, that our base momentum model behaves like this, right? But if you add risk management, which is some sort of stop losses, take profits, also control on your turnover. If you add all this, our performance increases, and once you add your deallocation policy, the performance also increases even further, right? So all these models we think will do really well in the long term. The short-term volatility is part of the process. It is part and parcel of the equity investing. But if you are looking for high returns in your capital, you have to be invested into equity strategies for the long term. And volatile markets are part of the process, and we will be managing the extreme volatility through our risk management measures. Now, to end the presentation, what you can also do to save yourself from the volatility is to, you can actually take advantage of the bear market and make the most out of it by investing through SIP, right, or rupee cost averaging. So if you look at the chart here, right, if you invested when the market was going down and when the market was going up, right? So instead of doing a lump sum here, if if you divided your money and you did an SIP, you would see that uh, your average buying price, right? If you bought at highs also and at lows also, your average buying price will be much lower than your average buying price if you did a lump sum investment and the market crashed, right? So, so you can take advantage of the bear market by starting in SIP right now, accumulating at a low price, and when the market recovers, you will see that your average buying price is much lower than what would have happened if you had done a lump sum at a top, right? So that is the end of my presentation. I will now take you to Siddharth, who will start the Q&A here, and
Yep.
yeah.
Hello, everybody. Thank you for the presentation, Sonam. We have a lot of questions pouring in. I've made note of everybody, and we'll definitely, try to address all the questions. Also, we did share our community link where people posted questions before the session itself.
Yeah,
So
so
first, we'll take up those questions.
I just flash our community link. So we are looking to start this community, right, where you can actively start, posting questions and we can discuss it. So we will moderate it and you guys can, actively discuss whatever is happening in the market, whatever, your expectations are here.
Right.
So I'll post it here. Click.
Perfect, Sonam. So should we start addressing the questions?
Yeah, so we have another poll going on right now, right? Which is open.
Yes.
So we'll keep it open for some time and then let's do the Q&A and let's keep it open.
Sure, sure. So questions from the community first, right? So the first question, Mith Kumar is asking, are we in a stagflation, inflation, or a recession phase?
Yeah, so see, like I addressed, right, that the people who are most concerned, right, who think that inflation is going to blow up and growth is going to just go down, they think that we will go into stagflation. So those are the alarmist people, uh, but they are still concerned. If you look at some of the macro variables like the yield spread, which has turned negative, right? Your short-term bond yields are higher than long-term bond yields. So that typically ends up in recession based on historical data. People are concerned about that, uh, and there is another set of people who think that the inflation is actually going to come down if you try to understand the dynamics of the market, right? So that is inflation. So I sort of believe that, it might be a deflationary environment that might happen. And because of the hiking of rates, we can see some sort of, deceleration in growth, right? So that might also come.
Sure. I think few guys were saying my voice wasn't clear in the chat, so I hope that's better now.
Yeah, yeah, I
If you
think it's
guys can hear me clearly, perfect. Perfect, Sonam. So the next question is from Mohammed. He's asking, is it still having gold still a hedge now? Why gold is not performing well with the downtrend?
we added gold as a hedge, which worked for some time, right? Which worked while that problem in Ukraine was the bigger thing, right? When during the Ukraine crisis, gold prices appreciated a lot, but now over the last 1 month, gold has depreciated a little bit, which is because all the metals, right, all the quantities sort of went through a correction, right? So which is one of the reasons why people, the hike that had happened during the top of the Ukraine crisis sort of eased and all the metals corrected. So that is the reason why gold has corrected a little bit. But obviously, if we get into bearish territory for a longer term, gold would be a good place where you can hedge it.
All right. Perfect. The next question is from Bala Krishnan. He's asking how weekly rebalance can build wealth over long time. So Wright Research is following pure technicals rather than fundamentals, is it?
So all our portfolios are monthly rebalanced. Only the momentum portfolio that was also monthly rebalance during these volatile times over the last 3-4 months. We have switched to weekly rebalancing so that if there is suddenly something that happens on a weekly basis, we can address it, right? So this is short. I mean, obviously, momentum is based on technicals, right? Momentum is a technical strategy, but we will do it. We'll try we always try to keep the churn less, right? So on every week we don't change the stock. Every week you are not getting a replacement of stock. It only happens at a regular interval, and in the future as the market becomes stable, we will switch back to monthly rounds.
Okay, so the next question is from Rahul. He's asking about buying on dips and what is the maximum investment in small case.
So we haven't kept like a maximum limit on our small cases, right? But I think, see, when you invest in a small case, you end up sending direct market orders, right? You end up sending, if you are going to invest 20 lakhs, all 20 lakhs will go as a single, I mean, for all the stocks, there will be a single order, right? So as your size increases, there is a issue, right? After a certain size, you will face an impact from the market, right? If you're going to buy 50 lakh worth of a single stock, then obviously you will get a bad price because people will sell you at a very, very higher price. You will destroy the order book, right? So we think that you should invest up to 20-25 lakh. Don't go too high because market orders are being placed here. So that would be our interpretation.
Okay, so those were the questions from the community. Now we'll be taking up the questions from the YouTube chat. So the first question is from Jayanti. She's asking how to find the details of the fall in large cap, small cap, and mid cap. Is there a website that you could suggest?
Well, you can just go to money control, you can go to ticker tape, you can go to even Google it, right? So I think that all is public, right?
Got
So
it.
that we can't anyway.
Can you hear me now?
Yeah, yeah, yeah.
Okay. So the next question is from Sandeepan. He's asking, in this bear market, can we invest in small cap stock for long term, or we need to wait for the market to stabilize a bit more?
So surprisingly for us, our, like I said, our small cap portfolio has outperformed by a good margin during this crash, right? Like I said, so if you look at 1 month performance of our small cap, we have outperformed the small cap index by 5%. And in the 6 month horizon, we have outperformed the small cap index by 14%, right? So which is surprising. But still we would say that you should be a little bit careful, right? That in these extreme volatility scenarios, there could be issues of volatility, especially in smaller stocks, right? In smaller stocks, if somebody dumps their shares, it causes a lot larger impact, right? Because the market cap is smaller, right? So we would say that you can invest, but better do an SIP than do a lump sum investment, right?
Got it. Um, so the next question is from Renault. He is asking, is there a group offer for three portfolios in Wright, say momentum plus value plus India focus, rather than paying for each individually?
Hmm. See, we don't have such a package right now because it is a little difficult to do that on in a good way in the current small case thing that we have. There's no easy way for us to offer a package. But once small case adds that feature for us, we will be looking to do that.
Okay. So there's another question. Does Wright have plans to develop Nifty level conditional preset auto trades?
Um, so I mean, I don't think I understand it really well. What he means is that based on Nifty level, we are giving them a buy and sell only on the index. So we do have some index strategies which are more, intraday out there, which are not on small case, which are out there on other partner websites that you can look at. And we're looking at, creating more such options.
Right. Another question from Sandeepan. He's asking, does Wright have any plan to bring any portfolio for small investors? For example, 10K, 25K in that range.
Yes, so we are actually working on even smaller ticket sizes. Like we're working on portfolios of 1,000, 5,000, even smaller. And this we are collaborating with one of our partners, which we're working on. We'll announce it whenever it's ready. But we are going to create, smaller baskets for people who want to invest there. So this is something that we're doing right now.
Okay.
We'll announce it when we're ready.
Right. Does Wright have any web APIs to get the weights in stocks recommendation callback?
No, not really. We don't have, but you can email us. We can explore this. We'll talk to you about it.
Okay. Another question. Reasons for buying a stock that are well below 200 DMA. What is the risk control strategy? And can the portfolio be hedged with other means?
See, buying a stock below at 200 DMA is actually not a bad thing, right? Because it is undervalued stock if it is below 200 the moving average, right? So it is a good time to buy that particular stock based on conventional knowledge. Obviously, in a bull market, you don't want to do that. You want to buy stocks that are training, right? So we do try to, we might end up sometimes buying undervalued stocks. Sometimes, we bet on overvalued stocks. It totally depends on the market conditions.
Okay. Um, so there's another question from Pranav. He's asking, is it wise to believe in the momentum strategy in the present situation of world economies?
See, we think that our momentum strategy it is a very strong strategy even during bear markets, right? So in a extreme crash, right, where a very short term panic crash, right, like some amount of it is what we saw in April, right? There was some sort of a panic selling out there. In those times, momentum might do bad, right, for very very short span of time. But in sideways market, in volatile market, in bull market, momentum always does better. And if you are a momentum investor, you would have seen that now our allocation have dynamically switched, right? So we have, we have allocated to pharma, we have allocated to FMCGs, we're dynamically shifting automatically to sectors suitable for any particular regime, right? So momentum is a very, very dynamic strategy that adapts, right? So it works well in most of the market scenarios and in extreme volatility, we try to address it by our day allocation policy and we try to keep it a little safer.
All right. Also, guys, there are so many questions. So, given the interest of time, we might not be able to take all the questions. However, you can post it on the community and we'll definitely address the same. So there's this question from Sriram. He's asking, what is the recommended small case to invest at this time? I am looking for growth oriented. I'm in a position to take some risk as well.
Yeah. So if you ask me right now, I would say, go with either our balanced portfolio or our momentum portfolio, because like I said, it stays strong during bear cycles also. And if you have a slightly longer term outlook, right? So like I said that, as the inflation eases in some time, if it eases, which I expect it to ease, we will see a lot of infrastructure spending happening, right? So the new India portfolio that we have, it will stand to gain a lot because the government of India will start spending in those PLI schemes and things like that. So I think that would also be an interesting portfolio for the long term. But innovation portfolio, is a very strong portfolio for a good market. So and innovation actually gains traction in bear markets, right? The innovators start working harder when the times are tough. So I think that is also an interesting portfolio to look at. So I would recommend these three portfolios.
So there's a question from me. Sonam, based on your research, how does momentum perform in bear markets?
Can you repeat it once?
He's asking, based on your research, how does momentum perform in bear markets?
How does momentum perform in the bear market? So I actually have a few slides that I can share with you guys, right, about momentum and its performance in different scenarios. Just bear with me for a couple of minutes, right? Right. So I have here responded to the momentum portfolio in two such volatile scenarios, right? One is March 2020 and one is your demonetization period, the two volatile periods we saw before this year's volatility, right? So you would see that momentum might do plus minus 2-3% during the volatile time, right? But it always picks up higher than it recovers faster, right? Because it will do a very, very fast recovery, right? So this is what happens in this scenario. But apart from that, like I said, we have a deallocation policy in place whenever there is an extreme volatility, we deallocate, put the money into cash and dampen the fall, right? So we are doing that also. And in any other market, right, where the market goes sideways or it stays static, you will see that momentum will do better.
Right. Okay. So there's another question. Is the SEBI investigation affecting Wright's business model as especially more efficient?
So I think the SEBI thing, there is a lot of ambiguity there. I am not sure if the RA businesses are going to be affected. I don't have the slide I can answer it for you, but at least for investment advisors, which is what Wright research does, I have taken the opinion from a few illegal minds and even SEBI. So we are in the clear, so there's no impact on our business.
Okay. So a question from Suresh asking why conservative returns show negative.
Why does a conservative portfolio do negative? See, even in our conservative portfolio, right, we do have some equity exposure, right? So while the conservative portfolio doesn't go down as much as your market, right? So if you look at the performance over the last 1 month, a conservative fell down only 0.5% when the market went down almost 10%. Right, so conservative stays strong, but still it has equity exposure, and if all equities are going to fall down rapidly, you will see some depreciation in that portfolio also, right? So conservative is like it is not a bond portfolio, right? If you had pure bond portfolio, you will get a very small yield out of it, which will not help you in this inflationary environment. That's why we have to add equities to it, and equities they give you appreciation during good times, but they there will be, a little bit of a drawdown even during working time.
I think we have most of the questions from the chat window as well. So just in case we missed out, you can check the community page.
Yes, so guys, like I said, we do have our new community page out here. We'll give you a link on our website also to email about it. But we really want you guys to be early adapters of this, start putting your questions out here, and we will discuss everything, right? We will moderate, we'll try to add a lot of insights out here, right? Make it like a knowledge box for our Wright community. So please go to the link that is being flashed here, and let's start posting questions. Let's start participating in discussions here. Where everything that we are doing stays together at the same place, and we can create good knowledge for our role or overall base, right? So that is, I think, that's all we wanted to cover. If we recommended a few portfolios for you, we think, we will be, we love risk management in Wright research. So even with the volatility, we will end up stronger than the index. We will manage it very, very proactively. So please don't worry about it. Please look at our small case page and, start your SIPs right now because, as the market recovers, right, so it will recover sometimes, you will get a lower average buying price if you are doing an SIP right now. So that would be my parting thought. That is what we wanted to talk to you about. Thanks a lot, Siddharth, for this Q&A round. And thanks a lot, everyone, for joining us.